This audio case is brought to you by Laudio. Commissioner v. Glenshaw Glass Co., Supreme Court of the United States, decided March 28, 1955. Opinion. Mr. Chief Justice Warren delivered the opinion of the court. This litigation involves two cases with independent factual backgrounds yet presenting the identical issue. The two cases were consolidated for argument before the Court of Appeals for the Third Circuit and were heard en banc. The common question is whether money received as exemplary damages for fraud or as the punitive 2/3 portion of a treble damage antitrust recovery must be reported by a taxpayer as gross income under Section 22A of the Internal Revenue Code of 1939. In a single opinion, the Court of Appeals affirmed the tax court's separate rulings in favor of the taxpayers. Because of the frequent recurrence of the question and differing interpretations by the lower courts of this court's decisions bearing upon the problem, we granted the Commissioner of Internal Revenue's ensuing petition for certiorari. The facts of the cases were largely stipulated and are not in dispute. So far as pertinent, they are as follows. Commissioner v. Glenshaw Glass Co. The Glenshaw Glass Company, a Pennsylvania corporation, manufactures glass bottles and containers. It was engaged in protracted litigation with the Hartford Empire Company, which manufactures machinery of a character used by Glenshaw. Among the claims advanced by Glenshaw were demands for exemplary damages for fraud and treble damages for injury to its business by reason of Hartford's violation of the federal antitrust laws. In December 1947, the parties concluded a settlement of all pending litigation, by which Hartford paid Glenshaw approximately $800,000. Through a method of allocation which was approved by the tax court and which is no longer an issue, it was ultimately determined that, of the total settlement, $324,529.94 represented payment of punitive damages for fraud and antitrust violations. Glenshaw did not report this portion of the settlement as income for the tax year involved. The Commissioner determined a deficiency claiming as taxable the entire sum, less only deductible legal fees. As previously noted, the tax court and the Court of Appeals upheld the taxpayer. Commissioner v. William Goldman Theaters, Inc. William Goldman Theaters, Inc., a Delaware corporation operating motion picture houses in Pennsylvania, sued Lowe's, Inc., alleging a violation of the federal antitrust laws and seeking treble damages. After a holding that a violation had occurred, William Goldman Theaters, Inc. v. Lowe's, Inc., the case was remanded to the trial court for a determination of damages. It was found that Goldman had suffered a loss of profits equal to $125,000 and was entitled to treble damages in the sum of $375,000. Goldman reported only $125,000 of the recovery as gross income and claimed that the $250,000 balance constituted punitive damages and as such was not taxable. The tax court agreed, and the Court of Appeals, hearing this with the Glenshaw case, affirmed. 1. It is conceded by the respondents that there is no constitutional barrier to the imposition of a tax on punitive damages. Our question is one of statutory construction. Are these payments comprehended by Section 22A? The sweeping scope of the controverted statute is readily apparent. Section 22, Gross Income. A. General definition. Gross income includes gains, profits, and income derived from salaries, wages, or compensation for personal service, of whatever kind and in whatever form paid, or from professions, vocations, trades, businesses, commerce, or sales, or dealings in property, whether real or personal, growing out of the ownership or use of, or interest in such property, also from interest, rent, dividends, securities, or the transaction of any business carried on for gain or profit, or, emphasis added, gains or profits and income derived from any source whatever. This court has frequently stated that this language was used by Congress to exert in this field, quote, the full measure of its taxing power, end quote. Helvering v. Clifford, Helvering v. Midland Mutual Life Insurance Co., Douglas v. Wilcuts, Irwin v. Gavitt. Respondents contend that punitive damages, characterized as windfalls, flowing from the culpable conduct of third parties, are not within the scope of this section. But Congress applied no limitations as to the source of taxable receipts, nor restrictive labels as to their nature. And the Court has given a liberal construction to this broad phraseology in recognition of the intention of Congress to tax all gains, except those specifically exempted. Thus, the fortuitous gain accruing to a lessor by reason of the forfeiture of a lessee's improvements on the rented property was taxed in Helvering v. Brune, cf., Robertson v. United States, Rutkin v. United States v. Kirby Lumber Co. Such decisions demonstrate that we cannot but ascribe content to the catch-all provision of Section 22A, quote, gains or profits and income derived from any source whatever, end quote. The importance of that phrase has been too frequently recognized since its first appearance in the Revenue Act of 1913 to say now that it adds nothing to the meaning of gross income. Nor can we accept respondents' contention that a narrower reading of Section 22A is required by the Court's characterization of income in Eisner v. Macomber as, quote, the gain derived from capital, from labor, or from both combined, end quote. The Court was there endeavoring to determine whether the distribution of a corporate stock dividend constituted a realized gain to the shareholder or changed, quote, only the form, not the essence, end quote, of his capital investment. It was held that the taxpayer had, quote, received nothing out of the company's assets for his separate use and benefit, end quote. The distribution, therefore, was held not a taxable event. In that context, distinguishing gain from capital, the definition served a useful purpose, but it was not meant to provide a touchstone to all future gross income questions. Here we have instances of undeniable accessions to wealth clearly realized and over which the taxpayers have complete dominion. The mere fact that the payments were extracted from the wrongdoers as punishment for unlawful conduct cannot detract from their character as taxable income to the recipients. Respondents concede, as they must, that the recoveries are taxable to the extent that they compensate for damages actually incurred. It would be an anomaly that could not be justified in the absence of clear congressional intent to say that a recovery for actual damages is taxable, but not the additional amount extracted as punishment for the same conduct which caused the injury. And we find no such evidence of intent to exempt these payments. It is urged that reenactment of Section 22A without change, since the Board of Tax Appeals held punitive damages non-taxable in Highland Farms Corp., indicates congressional satisfaction with that holding. Reenactment, particularly without the slightest affirmative indication that Congress ever had the Highland Farms decision before it, is an unreliable indicum at best. Moreover, the Commissioner promptly published his non-acquiescence in this portion of the Highland Farms holding, and has, before and since, consistently maintained the position that these receipts are taxable. It therefore cannot be said with certitude that Congress intended to carve an exception out of Section 22A's pervasive coverage. Nor does the 1954 Code's legislative history, with its reiteration of the proposition that statutory gross income is, quote, all-inclusive, give support to respondents' position. The definition of gross income has been simplified, but no effect upon its present broad scope was intended. Certainly punitive damages cannot reasonably be classified as gifts, nor do they come under any other exemption provision in the Code. We would do violence to the plain meaning of the statute and restrict a clear legislative attempt to bring the taxing power to bear upon all receipts constitutionally taxable, were we to say that the payments in question here are not gross income. Reversed. Mr. Justice Douglas dissents. Mr. Justice Harlan took no part in the consideration or decision of this case. For more audio cases, visit us at laudioforlisteners.com. Follow us on Instagram and Facebook, and subscribe to our YouTube channel.